let's talk about the Coupa deal. And SAAS, this is right up your alley.
I haven't paid a lot of attention to it, to be honest.
Oh, really?
The thing you guys asked is like, what signal will Elon's moves at Twitter be for the rest of the tech industry?
Mm-hmm.
I think the biggest wake-up call is to actually PE companies. So if you played this out and you think that Coupa is,
Explain what Coupa is, please.
Coupa is a software as a service company that does revenue management, I guess, or expense forecasting, or something in the financial realm. Yeah. I don't particularly know, to be honest. But anyways, this is a company that was off 70 or 80% from the high, like a lot of SaaS companies were when rates started to go up. And they got this offer from Thoma Bravo. But here's what's so interesting about this deal. If you think that, these guys bought a company, I'm just going to make up a number, at 20 times EBITDA, right? And you see Elon at Twitter and you think, well, wait, maybe we can't cut 75%, but maybe we can cut 50% of headcount and the company can still do well. And, you take half of the expenses out of the business, all of a sudden, if your EBITDA doubles, you're actually buying it at 10 times. So I think the thing that is the real insight here is twofold. Private equity can still put out a lot of private credit to fund these deals. And SaaS companies are perfect because they have huge free cash flow, right? So instead of funding it based on earnings, they can fund it based on ACV and ARR. So private equity will be super active. And two, all these RIFs basically show what the efficient frontier is for the number of employees you need to run a company. And if you can cut 50% of the headcount, private equity folks will do that. And so I think Coupa is like the canary in the coal mine. It is the beginning of what I suspect is a tidal wave of PE-sponsored deals in tech companies, largely SaaS, but may go into other realms.
Yeah, recurring revenue that can go profitable.
Taking advantage of these two things. Tap the private credit markets and finance it based on ARR, and then fire 50% of the team and double earnings capacity.
SAAS, your thoughts?
So on Coupa, I thought the most interesting thing was just we got a public comp. Well, we got a comp on what private equity is paying for public companies right now. So the deal happened at an $8 billion valuation. That was a 31% premium to the public price. It was 8.4 times next 12 months revenue. And on a trailing basis, it was about 10.4 times the last 12 months revenue. And by the way, all the comments were around what a rich price Thoma Bravo was paying. People generally thought they were paying a premium to the valuation. So
by the way, SAAS, it was 77% premium before the rumors came out that this was happening. So it was a pretty big premium.
Yeah, good point.
And there was a bidding war with Vista. And so it was a really rich kind of deal that got done here.
Right. So my point is that people thought this was a really rich deal, and yet the valuation multiples are so much lower than what private company founders expect. So remember last year at the peak, founders were thinking 100 times ARR was normal. 100 times. And you could roughly say, ARR is roughly equivalent to next 12 months revenue. It's not perfect, but it's roughly the case. So these founders were expecting a valuation multiple 10 times what the public markets are paying. And the public and actually the public markets are half of where Thoma Bravo was in this particular deal. So the public markets right now are valuing the median SaaS company at about 5.5 times. And a high growth, that'd be for like a 20% year over year growing company. And they're valuing the high growth companies at maybe 8 times. And Thoma Bravo did this at 10 times. So that gives you a sense of what the ballpark is. And these are companies that are already public. They're at scale. They're doing roughly $1 billion of ARR. They have already kind of won their category to some degree. Whereas private companies are subscale. They're, typically you're talking about companies with 1, 5, 10, usually under $20 million of ARR. They're not de-risked. There's still a ton of risk. We've seen many SaaS companies fizzle out and plateau at 20 million of ARR, never get to 100 million, never mind $1 billion. And yet these founders think that they're entitled to, even in this market, 30 to 40 times ARR. No way. I mean, it's getting to the point now where, maybe it should be 10 times, 20 times, max and that'd be for a company that's growing 2.5, 3x year over year. So I still think that, so I think basically what we're seeing here is even a good scenario like a Coupa acquisition that was done at a premium, it's still a wake up call to the private markets that the valuations are still completely and utterly out of whack.
Yeah. Let me ask you a question, Zach. So this company was growing 45% last year. They're growing 35% this year, and they got this multiple. Why is it not worth a significantly higher multiple if a company's growing 2.5 to 3x, which is 250%, 300%? And these guys are only growing 35%.
Sure. I mean, it is, and that's what you're paying a premium for.
Yep.
But here's the theory of it is that if you can invest in a private company that's say tripling year over year, and they can do that for another 5 years or whatever, then you're paying for that.
You're paying for that outcome in a couple of years, right?
Yeah, basically. Well, think about it.
You're getting a discount to the outcome in a couple of years.
Well, if you're paying 30 times today and it triples next year, you're only paying 10 times next year, and if it triples again, you're only paying 3 times. So if that keeps going, that's where your arbitrage is. But here's the thing: you have to weigh against that is that these early stage private companies, many things go wrong.
Yep.
And they hit a plateau, they fizzle out, or their growth rate starts to, the bigger they get, the harder it is to grow.
So they should be priced at a discount, not a premium, because there's risk.
There's more risk. They're growing faster, but there's more risk. But also, it's very hard once you get to a bigger number of ARR, 50, 100 million of ARR, it's extremely difficult to be doubling or tripling year over year.
Let me just point one thing out. So I looked at the numbers on Coupa. I think they had about 170 million of stock-based comp expense in the last 9 months. So those are employees that are getting $170 million in compensation in the form of shares. So they get those shares. They can then sell those shares and get cash for them.
On the public markets.
And then on the public markets and pay their bills. So when a company like this goes private, for those employees to just remain at their baseline comp, that stock-based comp needs to be replaced with something else, or else they're seeing their salaries reduced. So, there's this balancing game when these companies go private in terms of how do you give them the comp that they're earning to keep them engaged in the business?
The answer is you don't.
You
let them quit because you want to do a riff anyway.
Right. So, I mean, but for the people that stay, right. So there's a balance because it's not just, hey, cut the OpEx. You have to cut the OpEx, including stock-based comp. And this company generated about $210 million of free cash flow or operating cash flow in the last 12 months.
Yep.
So if you take out the stock-based comp, these guys are actually break even or losing money roughly.
Break
even roughly. So there's a real question mark on this business and businesses like this that go private, where if you actually cut the OpEx and you cut the salaries and you cut the headcount, but you have to find new ways to pay people because you've been paying them with stock in the past, how do you kind of bridge that gap? And I think that's probably a little bit of the balance and the art of what these guys do well.